Overnight futures rallied on an easing between the US and Iran. Nasdaq futures were up more than 1%. Oil just collapsed.
The market got the piece it wanted and sold AI chips anyway. Semiconductors closed deeply red.
So the question is, if AI demand is genuinely this strong, why does the build-out increasingly need the chip supplier to guarantee its customers' debt?
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let's look at the damage. The Dow actually gained ground, 52,210, up 0.51%. S&P 500 basically flat at 7,413, up 0.02%.
But the Nasdaq fell, 24,932, down 0.18%. It touched 25,262 intraday and just faded. Honestly, every index opened sharply higher and faded.
Russell 2000 up 0.62%. And yet the VIX is calm, sitting at 1867 despite the internal split. WTI crude fell 8.44% to $81.77.
That oil collapse was the biggest macro move of the day. It completely removes an inflation impulse right before Wednesday's Federal Open Market Committee, or FOMC, decision.
Gold closed at $4,084, up 0.41%. 10-year Treasury yield is at 4.64%. Globally, the FTSE 100 was up 2.44% and DAX up 2.07% on that energy relief, while the Nikkei fell 2.43% on chip exposure. So this is the one everybody was talking about by lunchtime. Nvidia is reportedly in talks to guarantee up to $250 billion supporting OpenAI's lease and construction debt. This is for a 10-gigawatt campus in southern Ohio being developed by SoftBank.
The site sits on federal land in Pike County, Ohio. It was actually used for uranium enrichment previously, which is a wild detail. Keep in mind, the guarantee covers lease and construction financing, not GPU purchases. There was a separate chip financing discussion reported up to about $350 billion.
Because OpenAI lacks an investment-grade credit rating, right? So a backstop from Nvidia improves the debt terms.
Right. But the scale here is just massive. $250 billion is roughly 96% of Nvidia's approximately $259 billion in total assets. And it's about 128% of its roughly $195 billion in shareholders' equity, as most recently reported.
Okay, slow down. Does Nvidia actually write a check for $250 billion today?
No. And that distinction matters more than almost anything else today. A guarantee is a contingent liability. It is only drawn on default. It is not cash out the door, and the terms aren't even final.
Even with that nuance, Nvidia shares closed down 4.99%, and the shape of it is a loop. The supplier backstops the customer, and the customer turns around and buys the supplier's chips. But hang on, if the demand is real, why does anyone need a cosigner at all?
Think of a commercial trucking company that wants to buy a huge fleet. It is clearly growing, but the bank looks at its credit file and says no. Or they say yes, but at an interest rate that kills the deal.
So the truck dealership steps in and cosigns.
Exactly. Nothing changes hands that day. No cash moves. The dealership just promises the bank, if they don't pay, we will. Now the loan gets done, the trucks get sold, and the dealership books the revenue.
I get that, but it still feels uncomfortable.
It is, because it can mean the dealership genuinely believes in the buyer and is willing to put its name behind that belief. It monetizes their balance sheet to unlock a build-out that ordinary debt markets would not finance. But it can also mean it was the only way anyone was going to finance the purchase. And from the outside, on day one, those two look identical. It makes it harder to tell how much of the order book is genuinely independent demand versus demand Nvidia itself enabled.
Which is why Michael Burry posted on X saying, "Around and around we go."
Right, pointing at the circularity. But that's an ex-post and a critic's view. It doesn't mean the deal will fail, or that demand is fake, or that Nvidia is in trouble. It just highlights the concentration and circularity risk in a transaction that is not yet final.
Meanwhile, over in memory, something genuinely staggering happened. Chinese DRAM maker CXMT just listed in Shanghai. It raised 57.92 billion renminbi, about $8.6 billion. Asia's largest IPO of 2026.
Priced at 8.66 renminbi, and it closed at 49 renminbi, up 466%, with intraday gains above 530%. The market cap hit roughly 3.3 trillion renminbi, or roughly $487 billion. It just passed ICBC to become China's most valuable listed company.
First quarter operating profit was 35.43 billion renminbi versus a loss a year earlier.
Sure, but let's put this in perspective. CXMT held only 7.67% of the 2025 global DRAM market. Its technology still trails Samsung, SK Hynix, and Micron. Plus, a small day one free float really amplified the move.
Right. A market cap is a statement about expectations. It's not a count of shipped technology.
Exactly. Still, memory names repriced heavily on the read-through. SanDisk fell 11.02%. Western Digital down 4.21%, Seagate down 4.07%, and Micron down 2.25%.
We saw a similar shock with ASML. The US listing closed down 5.88%, but its Amsterdam listing closed down 10.27%.
Mostly because Amsterdam closed nearer the peak of the panic. The US listing had 4 more hours to reassess.
The catalyst was a report that China has begun low-volume domestic production of immersion DUV, deep ultraviolet, lithography tools. We're talking roughly 5 tools in 2026 and about 20 in 2027. Compare that to the roughly 130 ASML immersion systems expected in 2026.
The capability is around 28 nanometers in a single exposure and 7 nanometers only through costly multi-patterning. First recipients include SMIC, Huahong, and CXMT.
5 machines against 130. That's not a supply shock.
No, it isn't. And that's what makes the size of the move interesting, because the number of tools was never really the point.
So why the huge sell-off?
Because the larger investor concern, the one that actually moves estimates, is potential restrictions on servicing ASML's large installed base in China. That recurring service annuity is economically much more important than the first handful of Chinese scanners.
For a second consecutive session, software beat semiconductors. The IGV index was up 3.33% versus SOX down 2.05% and SMH down 2.25%. The XLK was down 0.90%.
Software winners really rallied. Palantir up 7.00%, SAP up 6.88%, ServiceNow up 6.86%, Salesforce up 6.07%. Oracle up 4.27%.
And we saw broadening elsewhere. Consumer staples up 1.46%, consumer discretionary up 1.31%, communication services up 1.28%, financials up 1.01%. Energy fell 2.1% on the oil crash, and utilities fell 1.32%. But Theo, honestly, how does software that runs on AI chips rally while the chips themselves sell off?
Well, the read seems to be that software sits further from the capital expenditure bill and closer to the revenue. So it isn't being asked that financing question.
I don't know if I buy that. They're tied to the same ecosystem. 2 sessions is not a regime change.
Fair. I might be reading too much into a 2-day move. It's a likelihood game. No one can predict the future, and this is just one read of what the setup looks like today. We'll see if it holds.
Plumlee was out arguing that the semiconductor decline reflects Korean leveraged product unwinding and hedge fund degrossing rather than broken demand. He's saying holders should stay invested.
Before anyone runs with that, you should know where he's sitting. He's the executive chairman of BitMine. He's associated with the GRNW ETF, and he talked up both in that same interview.
Laughs. Right.
That doesn't make him wrong. It does mean you're hearing a view with a stake in it. The degrossing pace and his close to the bottom claims are assertions, not confirmed facts.
And to be balanced, semiconductor indices have no confirmed base yet. Plus, the Nikkei's 2.43% drop shows the pressure isn't only a U.S. story.
Exactly. I find part of his argument completely plausible, but part of it is unfalsifiable. You just have to weigh it carefully.
I keep going back and forth on this. It feels like the market hasn't stopped believing in AI demand at all. It has just started auditing how the build-out is financed and who will supply it.
Demand evidence is genuinely real, and it has to be given its due. Microsoft is reportedly short on compute capacity ahead of earnings. June's core capital goods orders rose 0.9%, with shipments up 1.9%. That's even though the headline durable goods number came in at just 0.3% against expectations of roughly 1.6%.
The demand is there, but the unresolved issues are financing quality, Chinese supply, and crowded positioning.
Which leaves us with the core open question tonight. When a chip supplier has to guarantee its customers' debt, is that confidence in demand or a warning about financing?
Look, this is how we'd read it tonight, and we might be reading it wrong. So rather than pretend we know, here's what we're actually going to be watching to settle it.
Yes. First, is the guarantee actually signed, and on what terms? Does hyperscaler capital expenditure guidance hold up? Does memory pricing break? And does this software leadership survive past 2 sessions?
We're going to get some of those answers immediately. Tuesday brings consumer confidence, and the Fed's 2-day meeting begins. We get earnings from Coca-Cola, Boeing, UPS, Corning, and S&P Global. Then Visa, KLA, Seagate, NXP, and Ford after the close.
Wednesday is the Fed decision, plus Microsoft, Meta, Qualcomm, ARM, and Lam Research. Thursday brings second quarter GDP and the PCE inflation reading, plus Amazon and Apple. Friday is the employment cost index.
It's almost like the calendar was designed to test everything we just talked about. That's the wrap.
Back at it after the next print.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.